U.S. nat gas futures were around $2.05, halting the recent selling pressure that lowered prices to a near three-month low of just under $2 on July, as uncertain supply from major exporting hubs lifted demand for U.S. LNG. Global gas markets were impacted by the outage of one of two trains at Ichthys LNG plant in Darwin, Australia, and persistent setbacks in Norwegian gas fields, limited availability for key importers. The developments coincided with reports that Freeport LNG, the second-largest U.S. export facility, is pulling more than 2 billion cubic feet of gas per day and is on track to return to full production. Added capacity for U.S. LNG exporters increases the amount of foreign sales and raises buying competition for U.S. consumers. In the meantime, the latest report from the EIA showed that U.S. utilities added 22 billion cubic feet of gas into storage last week, surpassing market expectations of a 15 billion increase. Gas storage levels are now 16% above the 5-year average. Meanwhile, starting in April, the storage dynamic is gradually but steadily shifting towards a bullish stance. The amount of nat gas injected into storage is 15% or 166 billion cubic feet less than the previous 5-year average for the same period. Production of natural gas in the United States during the second quarter was similar to last year during the same period. But U.S. nat gas consumption was 3% or 3 billion cubic feet per day more, largely driven by increased consumption in the electric power sector. I would expect nat gas injections for the remainder of the injection season will be 27% or 265 billion cubic feet, less than the 5-year average, narrowing the surplus in inventory to 6% above the 5-year average by the end of the injection season. Surprisingly, speculative traders are reluctant to acknowledge this trend. However, like clockwork, they snap to attention as the heating season begins. And you know all too well what that means for gas prices in such a scenario. Despite the shift to the September futures contract, the critical support level remains at the psychological $2 mark. Should this level break, we might see a potential test around $1.90. The primary trend is currently downward. A climb above $2.30 would shift the main trend to upward. While a trend change is not anticipated at the moment, a short covering rally towards at least $2.16 is possible. Following a prolonged decline in both price and duration, we're waiting for a higher close. This won't change the main trend, but could trigger a short covering rally, relieving some of the downward pressure. Please like, subscribe, and comment to support the channel. See you in the next one.